Imagine you've put your money into something that feels safe, predictable, maybe even a little bit dull, like a corporate bond. You're thinking steady interest payments, get my money back eventually. Simple stuff, right? But what if there are these hidden risks, tucked away in legal documents, or driven by these huge economic tides you can't even see? Things that could totally change how safe that bond really is.
Yeah, that's a common view, isn't it? Bonds mean safety, especially when you stack them up against stocks. And corporate bonds, they're a massive part of the U.S. market, foundational for a lot of investors. But you hit the nail on the head. The difference between a rock-solid bond and one with, well, hidden dangers often comes down to reading the fine print and understanding the bigger economic picture.
Exactly. It's not just about the yield you see advertised or the date it matures. You got to look deeper. So that's what we're doing today, a real deep dive into corporate bonds, specifically for you, the investor. We're peeling back those layers. We've got a whole stack of sources here, some financial articles laying out the basics, some really deep in the weeds research papers on complex economic links, and even chats from investor forums about practical choices people make.
Right. And our mission today is basically to cut through all that complexity. We want to pull out the really crucial insights on how these bonds work, what the key risks really are the ones you need to know about, and how to think about them for your own investments here in the U.S. market. The goal is to help you look beyond just the surface level stuff and feel, properly informed.
Okay, let's get into it then. Let's start with something really basic, something actually written into the bond's contract, but maybe easy to gloss over. Bond covenants.
Right. Think of covenants as the rule book for the company borrowing the money from you. They're legally binding terms, agreements set in stone between the company, the issuer, and you, the bondholder, the investor buying the bond.
So it's official, part of the actual deal, not just some kind of gentleman's agreement.
Oh, definitely not. These are serious legal obligations. And their main purpose, protection, mostly protecting you, the bondholder. They're designed to stop the issuer from doing things that might wreck their finances and, crucially, risk their ability to pay you back. They basically lock in a certain level of financial discipline and transparency.
Gotcha. So they're like guardrails for the company borrowing the money. What kinds of rules are we actually talking about? The sources mentioned two main flavors.
That's right, two main types. And knowing the difference tells you a lot about the protection you're getting. First, you've got affirmative covenants, sometimes called positive covenants. These are the must-do rules. They list specific actions the issuer has to take or conditions they must meet for the whole life of the bond. Think of them as promises to, keep their house in order financially.
Like promising to be a good corporate citizen, basically.
Exactly. Responsible borrower type stuff. The source gives some good examples, like maintaining enough insurance. Makes sense, right? Protects the company's assets, protects their ability to make money, which protects your repayment source. They also usually have to provide audited financial statements regularly, quarterly, annually. That's huge for transparency, letting you keep tabs on their financial health.
Okay, what else?
Well, other common ones are things like complying with all the laws, which seems obvious, but it's in there.
Yeah.
Maintaining proper accounting books, making sure the numbers are actually reliable, and sometimes, if the bond terms are linked to a credit rating, they might even have to promise to maintain a certain rating. It's all about keeping the company stable, transparent, and playing by the rules.
Okay, so affirmative is about doing the right things. What about the other side, the negative covenants?
Right. Negative, or sometimes called restrictive covenants. These are the don't do rules, the prohibitions. They specifically forbid the issuer from doing certain things that could hurt their creditworthiness or just make it harder to pay you back. These are really about stopping risky behavior that could put your investment in jeopardy.
This sounds like where the real teeth might be for investor protection. What kind of things are they usually barred from doing?
Yeah, these are key. The sources highlight a few big ones. One very common and really important restriction is on taking on more debt. This limits how much extra borrowing the company can pile on top of what they owe you. Without that, they could just borrow tons more, potentially making it tougher to pay you or, weakening your claim if things go south.
Okay, limits on more debt. What else?
Sometimes limitations on big spending, like huge new capital investments or acquisitions, or even limits on paying big dividends to shareholders if it would drain too much cash away from servicing the debt. These stop the company from basically funneling money elsewhere when they have obligations to you, the bondholder.
And you mentioned financial ratios earlier. Are those part of these negative rules?
Absolutely. Maintaining specific financial ratios is probably one of the most common and powerful types of negative covenant. These give you hard numbers, benchmarks the company has to stay within. They're designed to make sure the company doesn't get too leveraged or that its profits stay healthy enough relative to its debt.
Okay, let's dig into a couple of those ratio examples from the source. Why are they so important?
Sure. A classic one limits a ratio of total debt to earnings, often using EBITDA as the earnings measure. This sets a ceiling on how much debt they can have compared to their operating profit. And the why is pretty clear. It stops them getting overloaded with debt. If debt gets too high versus earnings, the risk of not being able to pay just shoots up. This covenant acts like a tripwire.
Right, a warning signal.
Exactly. Another key one is the interest coverage ratio. This requires the company's earnings, usually EBIT, earnings before interest and taxes, to be a certain multiple of its interest payments. Say, EBIT has to be at least 3 times the interest cost. This directly measures if they're earning enough from operations just to cover the interest they owe. If that ratio drops too low, it's a big red flag. It means they're struggling to generate cash just for interest payments, signaling higher default risk. It ensures they have the earning power to pay you.
Okay, so affirmative. Promises to do things. Negative. Promises not to do things, often tied to financial health metrics. Where do you actually find all these rules written down? Is it easily accessible?
Well, easily might be relative. All these covenants, plus all the other bond details, are laid out in a big, complex legal document called the indenture. Think of the indenture as the master contract for that specific bond issue. It's long, it's dense, full of legalese, but it's the absolute final word on the rights and responsibilities of both sides. And critically, it's legally binding and enforceable for the entire life of the bond, right up until it matures or gets paid off early.
So what happens if a company breaks one of these rules? If they cross a line, maybe fail to provide financials, or their debt ratio goes too high, even if they haven't actually missed an interest payment yet?
That's where this idea of technical default comes in. And it's a really important protection. A technical default is specifically when an issuer violates a covenant, breaks a rule in the indenture, even if they're still making their interest and principal payments on time. They haven't failed to pay yet, but they've done something or failed to do something that the contract says increases your risk as a bondholder.
And that technical default actually triggers consequences. It's not just a warning letter.
Well, it's serious.
Yeah.
The source mentions several common penalties. A big one is getting their credit rating downgraded by agencies like Moody's or S&P or Fitch. A lower rating immediately tells the market, hey, this company is riskier now. That can hurt the bond's trading price, and importantly, it makes it more expensive for them to borrow more money in the future. It creates a real financial disincentive to break the rules.
So it hits their reputation and future borrowing costs.
Exactly. And the source even mentions Moody's has this covenant quality rating scale from 1, which is best, strongest protection for bondholders, down to 5, which is the weakest. And there was this interesting fast fact noting that Moody's average covenant quality score actually weakened a lot in late 2020, hit a record high number, meaning weaker protections. Why? Because the market was resurgent. When money is easy to borrow, companies have more leverage in negotiations. They can push for terms that are more borrower-friendly, meaning fewer restrictions, weaker covenants for you, the investor. It shows how the economic climate directly affects the legal safety net you get in a bond.
That's really interesting. So market conditions can actually erode covenant protections. What about violating those affirmative covenants, the must-do things, like failing to send out financial statements?
Yeah, breaking one of those core promises, an affirmative covenant, can actually lead straight to an outright default. Now, indentures often have grace periods, like you get 30 days to fix this violation.
Yeah.
But if the company doesn't fix it within that time, then boom, that can trigger a full event of default under the bond's terms.
Even if they haven't missed a payment?
Even if they haven't missed a payment. And once an outright default is declared, the bondholders, the creditors, gain really significant power. They might be able to formally announce the default and, this is the kicker, demand immediate repayment of all the outstanding principal plus any interest owed right then and there. That's called acceleration. It's a huge lever for bondholders. It gives you the legal right to basically say, okay, you broke the contract, pay us back everything now. It forces the issue, even if the company hasn't technically run out of cash today.
Wow, that's a powerful tool. It means you're not just stuck watching if they break the rules. You might actually be able to do something. Okay, let's make this real. The source had that Hennepin County example. Tell us about that.
Yeah, it's a good illustration, even though it's a municipal bond, not corporate.
Yeah.
The principle of covenants providing security is exactly the same.
Mm-hmm.
So, back in 2016, Hennepin County in Minnesota issued bonds to help finance a medical center facility. Fitch, the rating agency, gave these bonds their highest rating.
AAA, that's the gold standard, right? Why so high?
Well, the source says it clearly. The bonds were backed by the county's full faith, credit, and unlimited taxing power. That means the county government itself guaranteed the debt, and crucially, they have the legal power to raise taxes on everyone in the county with no limit, specifically to pay back these bondholders if needed. That's incredibly strong backing.
Okay, so the government guarantee is huge, but what about the specific covenants?
Right. The source mentions some specific covenants for related bonds from the Hennepin County Regional Railroad Authority, which also got AAA ratings for similar reasons. One covenant stipulated they had to levy taxes sufficient to cover 105% of the annual debt service payment.
105%. What does that mean practically for someone holding the bond?
It means they weren't just promising to tax enough to cover the payment. They legally had to tax enough to cover the payment, plus an extra 5% buffer every year. That's a built-in margin of safety mandated by the contract. It's a clear, measurable promise going beyond just breaking even.
Okay, that's one specific protection. What else?
Another covenant mentioned looked at the maximum tax rate the county was allowed to charge. It stated that this maximum rate could generate revenue equal to 21.5 times the maximum annual debt service, or MADs.
Wait, 21.5 times what they needed for the biggest annual payment? That seems huge.
It is. It shows an absolutely massive capacity to raise the necessary funds. So if you're an investor looking at this bond, reading those specific covenants, the 105% levy, the 21.5x coverage tells you so much more than just seeing AAA. You understand why it's AAA, you see the legal muscle, the commitment ensuring you get paid. It gives you real concrete insight into the safety of that particular bond.
Okay, stepping back then, what's the big picture takeaway on covenants for someone investing in corporate bonds?
The main thing is, covenants are your contractual safety gear as a bondholder. They're not just fluff. They provide a really vital layer of legal protection by setting clear, enforceable rules for the company. They tell you what the company promises to do, affirmative, and what it promises not to do, negative. And crucially, if they break those promises, covenants give you legal options, potentially even getting your money back early via acceleration. So, understanding the covenants in a bond's indenture is just fundamental to knowing how safe it really is and what your rights are.
That definitely lays a strong foundation on the contract side of things. But like you said, bonds don't live in isolation. They're hit by bigger economic waves. Let's shift gears now to something maybe a bit trickier. How inflation risk plays into corporate bonds, specifically their credit spreads.
Yes, this is where it gets really fascinating because we usually think about inflation and bonds purely in terms of purchasing power, right?
Yeah, the fixed payment buys less stuff over time, standard inflation risk.
Exactly. That's straightforward. But the research paper we looked at digs deeper. It asks, how does uncertainty about inflation, the risk around it, affect the bond's credit risk? The actual chance the company might default. Those feel like two different buckets of risk.
They do seem separate. How are they connected?
Well, the research argues very strongly that time-varying inflation risk is a major driver of corporate bond credit spreads. And importantly, this link is separate from how inflation risk hits government bonds, which don't really have that same kind of default risk.
So inflation risk doesn't just make your payments worth less, it can actually make the company more likely to fail. Is that the idea?
That's precisely the core idea. The paper highlights two key aspects of inflation risk that seem to be particularly damaging for corporate credit quality, pushing spreads wider. First is inflation volatility. Just the pure uncertainty about how big future inflation surprises might be. Will inflation shoot up? Or maybe more critically here, will it unexpectedly fall? Second is inflation cyclicality. This is about how inflation tends to move with the economy. Does it go up when times are good, pro-cyclical, or does it go up when times are bad, counter-cyclical, like stagflation? Okay, volatility, how big the surprises are. Cyclicality, when the surprises happen relative to the economy. How does that make a company more likely to default? The key mechanism here is something called debt deflation. Let's put ourselves in the company's shoes. They issue a long-term bond with fixed dollar payments, nominal debt. When they do that, maybe they're expecting inflation to run at, say, 3% a year for the next 10 years. They might factor that into their planning, thinking, okay, the real value of those fixed dollar payments we have to make will slowly shrink over time. But what happens if inflation comes in lower than expected? Say it drops from that expected 3% down to only 1%.
The dollars they have to pay back are suddenly worth more in real terms than they planned for. The debt feels heavier.
Exactly. That's debt deflation. The source points out it can happen anytime inflation is lower than expected, even if it's still positive. It's the surprise drop relative to expectations that matters. That 1982 NYT quote about farmers struggling when inflation slowed down captures this perfectly. They'd borrowed expecting higher inflation to help them repay, and the slowdown actually increased their real debt burden, causing real pain.
Okay, I see.
And the paper gives a stark example. If the expected long-run inflation rate permanently drops from 3% to 1%, the expected real value of the principal repayment on a 10-year nominal bond jumps by 22%. Think about that. A 22% hike in the real cost of their debt, just because inflation undershot expectations. That puts a serious strain on a company's finances.
Okay, so unexpectedly low inflation makes the debt burden heavier in real terms. That's bad enough. But you mentioned it can hit twice. How does that work?
Right. This is where that cyclicality piece is crucial, particularly if inflation is pro-cyclical, meaning it tends to fall when the economy weakens during recessions. In that situation, during a recession, companies face a nasty double whammy.
What's the double hit?
First, it's a recession, so their business is suffering. Real asset values might be falling, sales are down, cash flow's weak. That's bad number one. Second, because inflation is pro-cyclical, it also falls during that recession. So at the exact same time, their real income and asset values are tanking. They're hit with unexpectedly low inflation, which, as we just discussed, makes their real debt burden higher.
Ouch. Low income, high debt burden simultaneously.
Precisely. The asset side of their balance sheet shrinks in real terms, while the liability side effectively swells in real terms. That interaction dramatically increases the odds of default. They just don't have the real resources to cover a debt that's suddenly become much larger in real terms. That's the hitting twice scenario. It leads to more defaults and bigger real losses for investors holding those bonds.
And this is extra bad because it happens when the economy is already tanking.
Exactly. And think about it from the investor side. This nightmare scenario, low assets, high real debt, happens during downturns. Those are the times when investors are most risk-averse, when preserving capital feels most important, when every dollar feels more valuable. Economists call that high marginal utility. Because this specific debt deflation risk is concentrated in those really bad economic times, investors logically demand more compensation, a higher default risk premium, to hold corporate bonds that carry this risk. And that higher required premium pushes credit spreads wider.
So spreads widen not just because of company-specific fears, but because investors are demanding pay for this macro risk that bites hardest right when things are bad anyway. That's a complex risk.
It really is. And the research paper actually builds a sophisticated dynamic model to try and quantify these effects. It includes things like time-varying inflation risk, long-term nominal debt, realistic company behavior.
And what does the model suggest? How big is the impact of this inflation risk on spreads?
Well, the model clearly predicts that both inflation volatility and that inflation stock correlation, the cyclicality measure, significantly push up corporate bond credit spreads. Without getting lost in the exact numbers, the simulated impacts are economically meaningful. The model suggests plausible increases in inflation uncertainty, or its procyclicality could add, 20, 30 basis points or potentially more to credit spreads in its runs.
So a noticeable impact.
Definitely. And what's really striking is that in the simulations, this model, driven by these real and nominal economic shocks and the inflation risk they create, could explain over 80% of the ups and downs in the simulated credit spreads. That tells you these inflation risk factors aren't just minor tweaks. The model suggests they're fundamental drivers of why credit spreads move. Okay, that's the theory. That's the model simulation. Does it actually hold up when you look at real-world data? Yes, it does. Quite strongly, actually. The paper presents empirical evidence using decades of data from 6 developed countries: Australia, Canada, Germany, Japan, UK, and the US.
And what did that real-world analysis find?
The key finding from the empirical work is that, on average, a typical increase, a 1 standard deviation move in either inflation volatility or that inflation stock correlation is associated with about a 14 basis point increase in actual credit spreads.
14 basis points. How significant is that?
Well, average credit spreads historically have been around, say, 100 basis points. So 14 basis points is definitely economically meaningful. It's a real chunk. Maybe slightly less dramatic than some of the model simulations, but clearly significant. And critically, this link holds up even after accounting for other known drivers of spreads, things like the overall business cycle, stock market volatility, company leverage ratios, and so on. It suggests this inflation risk channel is an independent factor.
It's not just reflecting something else.
Right. And the empirical data also beautifully shows that asymmetry the model predicted. The impact of inflation risk on spreads is much stronger when the economy is weak specifically, when real stock returns are low. For example, the difference in credit spreads between high and low inflation volatility periods was about 30 basis points larger during the periods with the worst stock market performance. That powerfully reinforces the hitting twice idea. Inflation risk really hurts corporate credit the most during downturns.
Wow, the real data matching the theory like that is compelling. The paper also mentioned a shift in historical concerns about inflation.
It did. It contrasted the 70s and 80s, when the big fear was stagflation, high inflation during recessions, which is countercyclical inflation. More recently, especially post-2000, with inflation generally lower, the worry shifted towards debt deflation, the risk of inflation falling too low during a downturn, making it pro-cyclical and exacerbating the real debt burden problem.
Like we just discussed.
Exactly. The source notes that news searches for debt deflation actually outnumbered searches for stagflation in the 2000-2009 period, which kind of highlights this change in focus. And Japan's struggles in the 90s are often held up as a key example of debt deflation challenges.
Right.
And it's also worth remembering, as the source points out, this isn't just about bonds. Unexpectedly low inflation also bloats the real cost of other fixed nominal promises, like defined benefit pension obligations. That was apparently a factor in the United Airlines bankruptcy context, for example. So the risk is broader.
That's a really good point. It hits other liabilities too. Now, beyond just explaining current credit spreads, does this inflation risk stuff actually help predict future problems for bond investors?
The research suggests it does, yes. Both inflation volatility and the inflation stock correlation were found to have predictive power for future corporate credit losses over the next few years, showing significance out to like 2 to 5 years. So high readings on these metrics today might signal potentially higher defaults down the road. They act as a kind of forward-looking warning signal.
Okay, predicts losses. What about predicting returns?
Interestingly, the inflation stock correlation measure specifically was found to predict future corporate bond excess returns. The U.S. data showed that higher correlation predicted higher future excess returns, noticeably higher over the next quarter and even more significantly over the next 5 years. But inflation volatility, while predicting losses, didn't show that same clear link to predicting future returns in this study.
So correlation predicts both future pain, losses, and potentially future gain, excess returns, while volatility mainly predicts the pain. That's nuanced.
It is.
Okay, this whole inflation risk mechanism makes sense, but it does raise a question. If issuing nominal debt has this clear risk tied to unexpected inflation, why do companies keep doing it? Why not just issue inflation-indexed bonds?
Yeah, it's a fair question. The paper touches on potential reasons from the company's side. Maybe issuing index debt has other costs or headaches, like maybe managing rollover risk if they use short-term index debt, or dealing with fluctuating real payments if they use floating rate index debt. Maybe there are agency costs, or perhaps investors just demand a higher yield, a liquidity premium, to hold corporate index bonds, making them more expensive for the company to issue than plain old nominal bonds. The model itself threw out a number suggesting nominal bonds might need to offer around 29 basis points extra yield before companies would see index debt as the better option.
So maybe companies issue nominal bonds just because it's cheaper or easier for them, even though it creates this inflation risk dynamic for both them and the bondholder.
That seems like a plausible interpretation of the trade-offs. And the research does suggest policymakers should probably take this debt deflation risk seriously, given its potential to worsen economic downturns.
Okay, this has been a really deep dive into a complex, maybe non-obvious risk. What's the absolute key takeaway for an investor from all this talk about inflation risk and credit spreads?
I think the core insight is this. Corporate bond risk isn't just about that one company or general interest rates. These big macroeconomic forces, specifically the uncertainty around inflation, its volatility, and how it moves with the economy, its cyclicality, these are real measurable drivers of credit spreads and predictors of future losses. And this risk bites hardest when inflation unexpectedly drops during bad economic times, magnifying the real debt burden. Understanding this gives you a much richer insight into why spreads move and what really signals danger in your bond holdings.
It definitely adds another layer to thinking about bond safety. Okay, let's shift gears one more time. We've talked contract rules, we've talked macro risks. Now let's get practical. How should investors actually hold these bonds? Individually or through bond funds? This came up a lot in the investor forums we looked at.
Yes, a very common and practical debate. And the specific question raised was, especially when rates are low or moving around, Why bother with bond funds? Why not just buy individual bonds yourself, particularly if you plan to hold them until they mature?
Right. Let's tackle that first, the case for buying and holding individual bonds. What's the appeal?
The main arguments really center on predictability and maybe a sense of control. If you buy an individual bond, say, from a solid company, and you just hold it till the end, assuming no default, you know exactly what cash you're getting back and when. You get those fixed coupon payments like clockwork, and you get your $1,000 principal back on maturity date. As one investor put it in the source, providing the issuer doesn't default, you get all of the interest that was agreed on at the outset. That certainty is really appealing to some people.
And what about interest rate risk for these individual bonds held to maturity?
Well, the thinking there is that interest rate risk becomes mainly opportunity risk. If rates go up after you buy, yeah, you missed out on locking in a higher yield elsewhere, but the actual dollars you receive from your bond don't change. The market price will fluctuate, sure, but if you don't sell before maturity, those paper losses or gains don't really affect your final payout again, assuming no default.
And there was that perception mentioned in the forum that individual bonds held to maturity don't crash like funds can when rates spike.
Exactly. That speaks to the NAV issue with funds. A bond fund's price, its NAV, drops immediately when rates rise because all the bonds inside it are suddenly worth less on the market. If you sell your fund shares, then you lock in that loss. With an individual bond, if you don't sell, you avoid realizing that market loss. You can just wait it out and get par value back at the end. That feels safer to some investors, even though technically the market value of their individual bond is also down.
Okay, so predictability and avoiding forced realization of losses, it held. If someone goes this route, what are the big things to watch out for when picking individual bonds?
Oh, credit quality becomes absolutely critical. If you only own one bond, or just a handful, the risk of that specific company defaulting is everything. The forum discussion really emphasized this. People talked about looking for high-grade stuff, stable municipal issuers like states, mutual bonds, or big counties, and maybe well-rated school districts. Go EA. You're essentially doing your own credit homework or relying heavily on ratings. They also mentioned using broker tools like Fidelity's Bond Finder to screen bonds based on rating, yield, maturity, etc.
Makes sense. So individual bonds offer that held-to-maturity predictability, but you really own the credit risk and the selection job. What about the flip side, the case for bond funds?
The arguments for funds usually boil down to diversification and liquidity. Diversification is probably the biggest one. If you hold just one or two individual bonds, you've got huge concentration risk. What if that specific company hits trouble? Or, as one person in the forum mentioned, thinking about local wildfires, what if some localized event slams that one specific municipality whose bond you own? A bond fund, on the other hand, might hold hundreds, even thousands of different bonds from all sorts of issuers, industries, maybe geographies. That massively dilutes the impact of any single default. It's the classic, don't put all your eggs in one basket idea.
Right, spreading the risk. What else?
Liquidity. Bond funds, especially mutual funds and ETFs, generally trade every day, like stocks. You can usually buy or sell shares pretty easily at the current NAV. Selling an individual bond before maturity, that can be way trickier. The secondary market for individual bonds, especially for smaller amounts or less common issues, can be thin. You might face big gaps between buying and selling prices, the bid-ask spread. It can feel like you're paying a penalty to get out, or it might just be hard to sell quickly at a price you think is fair, as one commenter noted.
So easier to get your money out of a fund if you need it, even if the price isn't what you'd hoped.
Generally, yes. And funds offer convenience too. Managing a portfolio of individual bonds means research, tracking dates, reinvesting coupons, handling calls or defaults. A fund manager does all that for you. You just buy the fund shares.
Okay, diversification, liquidity, convenience. Anything else?
Yeah, there's an interesting point about duration, especially for long-term goals like retirement. A typical broad market bond fund, or one targeting a specific duration like intermediate term, tries to keep its average duration relatively constant. As bonds mature and leave the fund, the manager buys new ones, keeping the fund's overall sensitivity to interest rates stable. For someone saving for retirement decades away, that constant duration might actually match their long-term liability profile better than a single bond whose duration shrinks to zero as it nears maturity. The Bogleheads Forum discussion touched on this idea of matching liability duration.
That's an interesting angle. What about those target maturity funds? They seem like a bit of both worlds.
They are. Target maturity funds are a neat hybrid. They're diversified like a fund, holding lots of bonds, but they have a specific end date, like target maturity 2030. The manager fills the fund with bonds that mature around that year. So as 2030 approaches, the fund's duration naturally shrinks, just like an individual bond. Then, in the target year the bonds mature, the fund usually liquidates, and you get your principal back. They give you diversification plus that defined endpoint. The source suggested they can be really useful for getting diversified exposure to corporates or munis where default risk is higher without having to build your own individual bond ladder.
Okay, so it really sounds like there's no single right answer. Individual bonds versus funds depends a lot on the investor.
Absolutely. It boils down to your specific situation. Do you truly intend to hold to maturity no matter what? How important is easy liquidity to you? How comfortable are you with concentrated credit risk? What's your time horizon? That rule of thumb from the forum seemed pretty sensible. If the yield on an individual bond isn't dramatically better than a comparable fund, like say 8% as 45%, the fund's diversification and liquidity often went out. But if you do find an individual bond with a really compelling yield from a high-quality issuer, maybe that extra return justifies the trade-offs in liquidity and concentration.
And crucially, whether you choose individual bonds or funds, everything we talked about earlier, the covenants, the inflation risk impacting credit spreads, that all still matters, right?
Oh, absolutely critical. Covenants define the legal reality of the underlying bonds. Inflation risk affects the fundamental safety and value of those bonds. A fund doesn't eliminate those risks. It just spreads them across many bonds. So understanding covenants helps you judge the quality of protection within the fund. Understanding inflation risk helps you grasp the macroeconomic forces influencing the fund's performance and potential for losses. It informs your decisions about fixed income allocation overall, regardless of how you hold it.
Okay, this has been incredibly thorough. We went from the nitty-gritty legal details of bond contracts
The covenant, yeah.
to these big, complex macroeconomic risks like inflation and how it surprisingly connects to default probability and credit spread.
That whole debt deflation mechanism.
And then landed on the very practical choice investors face between holding individual bonds or using funds.
Right. We've seen that corporate bonds can offer that predictability, that income stream, but they definitely come with layers of risk, some obvious, some less so. Knowing about covenants gives you power understanding your protections, what constitutes a default. Recognizing how inflation risk, its volatility, its timing, drives spreads and predicts losses, adds a whole other dimension to risk assessment. And applying all that helps you make that practical choice, individuals or funds, based on your needs and risk tolerance.
It's a great reminder that even with supposedly boring investments like bonds, really understanding them means digging deeper.
Couldn't agree more. So maybe here's something to chew on, building right off that inflation risk discussion. We talked about that historical shift, from worrying about 70s-style stagflation to more recent fears about debt deflation, especially during downturns. How does understanding that shift, plus the evidence that inflation risk does predict credit losses over time, how does that change the way you look at the risks in your bond portfolio right now? Does it make you think differently about how you position your fixed income investments given today's economic climate?
Something to definitely consider as you navigate the markets. Thanks so much for joining us on this deep dive.
My pleasure. Keep digging, keep learning,